Most traders enter the market thinking they need better entries, sharper analysis, faster execution. They chase patterns, study indicators, refine strategies, and still they bleed accounts dry. Not because their setups are wrong, but because they never learned the one truth that separates survivors from casualties. Risk management is not defense. It is dominance. And until you understand that, you will keep losing to traders who do. You see, the market does not care how smart you are. It does not reward the trader who calls direction perfectly 5 times in a row. It rewards the trader who is still standing after being wrong 10 times. Survival is not a passive state. It is an aggressive choice. It is the decision to enter every trade knowing exactly how much you can afford to lose and still wake up the next day unchanged. That clarity, that precision, is what makes you untouchable. And when you are untouchable, you become the most dangerous kind of trader. The kind who does not need to win to stay in the game. Most people think risk management means tightening stops or trading smaller. They think it is about playing it safe, protecting capital, avoiding big losses. And sure, those things matter. But that surface, level understanding is why they keep repeating the same mistakes. Real risk management is not about what you avoid. It is about what you control. It is about designing your trading in a way that removes the power from any single outcome. No trade can shake you. No loss can break you. No win can fool you into thinking you have figured it all out. That emotional neutrality is not something you meditate your way into. It is something you engineer through structure. Think about the last time you took a loss that hurt. Not just financially, but emotionally. The kind of loss that made you stare at your screen, replaying every decision, wondering where you went wrong, questioning if you even belong in this game. Now ask yourself honestly, was the problem that you were wrong about direction? Or was it that you were wrong with too much size, at the wrong time, with too much emotion tied to the outcome? Most traders blow accounts not because they lack skill. They blow them because they are skilled with no boundaries. They know what to do, but their risk does not match their discipline. And when those two things are misaligned, the market does not forgive. The dangerous trader understands something most never will. Losing is not the enemy. Losing without structure is. A controlled loss is just data. It tells you the market disagreed with your thesis. You move on. But an oversized loss, one that violates your rules, one that you justified in the moment because this time felt different, that kind of loss creates damage. It does not just hurt your account. It rewires your psychology. Suddenly you hesitate on the next setup. You second-guess your analysis. You overtrade trying to make it back. Or worse, you stop trading altogether because the fear of repeating that pain is louder than your desire to succeed. That cycle, that spiral, is how traders destroy themselves. And it all started with one decision to ignore their risk limits. Here is the shift most traders never make. They spend all their energy trying to predict what the market will do next. They study price action, watch volume, analyze sentiment, chase gurus who promise certainty. But the market is not predictable. Not in the way they want it to be. What is predictable is your response to it. What is controllable is how much you expose yourself to any single outcome. That is where your power lies. Not in knowing what will happen, but in deciding what you will risk regardless of what happens. When you internalize that, trading stops feeling like gambling. It starts feeling like execution. Let me tell you what this looks like in practice. Imagine two traders. Both have the same strategy, same win rate, same risk to reward ratio. On paper, they are identical. Trader 1 sizes based on conviction. When a setup feels perfect, they go bigger. When confidence is high, they push. When they are on a winning streak, they increase risk because momentum feels unstoppable. Trader 2 sizes the same every single time. Win or lose, confident or uncertain, they risk the exact same percentage on every trade. Same rules, same structure, no exceptions. Now fast forward 6 months. Trader 1 has had explosive wins and catastrophic losses. Their equity curve looks like a roller coaster. Some months they feel invincible. Other months they are rebuilding from zero. Their psychology is unstable. They trade based on how they feel, not what the data says. Trader 2, on the other hand, has steady growth. Nothing dramatic, nothing flashy. But every month, they are slightly ahead. Their equity curve trends upward with manageable drawdowns. Their psychology is calm. They do not celebrate wins or mourn losses because no single trade carries emotional weight. Same strategy. Different risk management. Completely different outcomes. That is the difference between treating risk as a variable and treating it as a constant. Most traders think flexibility in risk is smart. It is not. It is emotional. It is reactive. It is the disguise confidence wears when it wants to justify recklessness. Dangerous traders do not adjust risk based on how good a setup looks. They adjust risk based on how consistent their behavior has been. If discipline is holding, size stays the same. If discipline slips, size decreases. Not as punishment, but as protection. They understand that their greatest threat is not the market. It is themselves. And risk management is the firewall that keeps their emotions from hijacking their execution. Now let us talk about what happens when risk is wrong. Not slightly off. Catastrophically wrong. You have felt it before even if you did not realize what it was. You enter a trade. The size feels heavier than usual. You tell yourself it is fine, the setup is strong, you have done your analysis. But the moment price moves against you, something changes. Your chest tightens. You stop thinking clearly. You start watching every tick instead of following your plan. You move your stop loss because you convince yourself you just need more room. Or you close early in panic, only to watch price reverse and hit your original target without you. That is not weak psychology. That is biology. Your brain perceived a threat, and when size is too large, every normal pullback becomes a survival situation. No amount of mindset work can override that response. The only solution is correct size before the trade even begins. Here is the truth nobody wants to hear. If you cannot follow your trading plan under pressure, your size is too big for your current level of discipline. Not your skill level, your discipline level. Those are not the same thing. You might have the skill to identify setups, to read charts, to execute technically. But if you do not have the discipline to sit through drawdown without panicking, to take a loss without revenge trading, to wait for your edge instead of forcing action, then your size needs to reflect that gap. This is not about being harsh. It is about being honest. Most traders size based on how confident they feel on their best days. Dangerous traders size based on how disciplined they remain on their worst days. That is maturity. That is sustainability. And this is why so many traders sabotage themselves without realizing it. They increase risk after wins because they feel unstoppable. They decrease risk after losses because they feel fragile. This creates a cycle where risk becomes tied to emotion instead of structure. When you win, you should not feel invincible. When you lose, you should not feel broken. Both states are dangerous. Both states lead to decisions you will regret. Professional risk management is boring by design. Same size, same process, same rules, regardless of recent results. Let the edge play out over time. Stop trying to manufacture urgency. Urgency is the enemy of discipline. And discipline is the only thing that compounds. Think about how many times you have said to yourself, "I knew what to do, but I could not do it." That sentence haunts traders. They blame mindset, psychology, lack of focus. But that is not the problem. The problem is size. If you know what to do and still cannot do it, it means the trade carries too much emotional weight. The size turned execution into survival, and survival mode shuts down rational thinking. It is not your fault. It is design flaw. You are trying to force discipline in an environment where your nervous system is screaming danger. The fix is not willpower. The fix is smaller size. Small enough that following your plan feels easy, not heroic. Let me give you another example. You are in a trade. It is going your way. You are up 2-1 on your risk. You start thinking about taking profit early. Not because your plan says to, but because you do not want to give it back. You have been burned before. You have watched winners turn into losers. So you close. You lock in the gain. You feel smart for a moment. Then price continues without you and hits your original target. Now you feel cheated, frustrated. You start looking for another entry to make up for what you left on the table. You force a trade that does not meet your criteria. You lose. Now you are break even or worse. And the cycle repeats. This is not bad luck. This is incorrect size creating fear-based decision-making. If your size was appropriate, you would not be afraid of giving back profits. You would follow your exit plan because no single trade outcome threatens your emotional stability. The dangerous trader knows their maximum acceptable loss before entering any position. Not vaguely. Not approximately. Precisely. They know how many consecutive losses they can take without changing behavior. They know how much drawdown they can tolerate without revenge trading. This self-awareness is lethal in the market. Because the market feeds on emotional traders. It hunts impatience. It exploits desperation. It punishes overconfidence. When your risk is structured properly, you become invisible to those traps. You are no longer reactive. You are prepared. And preparation removes fear. Fear does not disappear because you become fearless. Fear disappears because there is nothing left to fear. Here is something most traders do not think about. Risk management is not static. It evolves. What is safe for a seasoned trader might be catastrophic for a beginner. What is acceptable during high focus might be reckless during fatigue. This is where self-awareness becomes non-negotiable. You have to know your current state. Are you sharp or distracted? Are you executing flawlessly or cutting corners? Are you patient or desperate? Your risk should adjust based on those factors. Not your confidence. Your consistency. If you have been following your process perfectly for weeks, maybe you test slightly larger size. If you have been breaking rules, you scale back immediately. No shame. No frustration. Just adjustment. That flexibility is power. Most traders wait for confidence before they respect risk. Dangerous traders respect risk until confidence becomes unnecessary. And this is where the transformation really happens. When risk is correct, something shifts inside you. You stop trying to be right. You start focusing on being consistent. You stop watching every tick like your life depends on it. You let trades breathe. You allow setups to fail without emotional collapse. This is when trading becomes calm. Not boring. Calm. There is a difference. Boring means you do not care. Calm means you care deeply, but you are not attached to outcomes. You are attached to process. And process is the only thing you control. Most traders believe position sizing is just math. A formula. Plug in your account size, your risk percentage, your stop distance, and you get a number. Don't. But that is not position sizing. That is calculation. Position sizing is psychological architecture. The size you choose reveals exactly how you think, how you feel, and how much control you truly have over yourself. Every oversized trade is a confession. It says you want this trade to matter. Every undersized trade taken out of fear is also a confession. It says you do not trust yourself. Position sizing exposes your emotional state more honestly than any journal entry ever could. The moment size is too large, your brain changes. Focus narrows. Breathing becomes shallow. You stop seeing the market clearly. You start managing money instead of managing decisions. This is not weakness. This is survival wiring. Your brain is trying to protect you from perceived danger. But in trading, that protection mechanism becomes your enemy. Because once your brain shifts into threat mode, rational thinking shuts down. You will close too early. You will move stops. You will hesitate. You will revenge trade. No mindset trick can override that response. The only solution is correct size before you ever click the button. Small enough that the trade does not threaten your emotional stability. Large enough that you still respect the process. This balance is what most traders never find. They either trade too small and feel disconnected, which leads to boredom and impulsive trades. Or they trade too large and feel overwhelmed, which leads to fear and self-sabotage. The dangerous trader sizes to stay neutral. Neutral is power. When size is correct, you do not hope. You do not pray. You do not negotiate with price. You observe, you execute, you accept outcomes. This is why professional traders can take 10 losses in a row without changing behavior. Not because they are emotionally strong. Because their size never put them in danger. Amateurs try to become emotionally tough. Professionals design size so toughness is not required. Think about that. How much energy have you wasted trying to force yourself to be fearless? How many affirmations have you repeated? How many mindset videos have you watched? And still, when the trade goes against you, the fear returns. Because you were treating the symptom, not the cause. The cause is size. Fix the size and fear loses its foundation. You are not afraid of being wrong. You are afraid of what being wrong will cost you. When that cost is manageable, fear evaporates. Let me tell you what happens when you get this right. You start trusting yourself. Not because you win more, but because you behave the same regardless of outcome. That trust is everything. Once you trust yourself, doubt weakens. Hesitation fades. You become predictable to yourself and unpredictable to the market. This is where traders cross from fragile to formidable, and it all starts with size. The right size turns chaos into routine. The wrong size turns routine into chaos. Now here is the part most traders resist. True risk management forces brutal honesty. You cannot hide behind hope. You cannot rely on just this once. You cannot negotiate with the market. You either respect your limits or the market enforces them violently. And the illusion many traders live under is that tighter stops or smaller risk will limit their growth. The opposite is true. Controlled risk expands opportunity. It allows you to trade freely, to execute without hesitation, to stay patient during drawdowns. Think about this deeply. If you knew with absolute certainty that the next 10 losses could not hurt you financially or emotionally, how differently would you trade? No fear, no urgency, no revenge. That is the psychological advantage of proper risk management. It gives you permission to think clearly. Most traders try to fix psychology directly. They meditate, they journal, they read books. None of it works long-term if risk is still misaligned. Psychology collapses under pressure. Risk management removes pressure. This is why elite traders obsess over position sizing more than entries. Because they understand something most never learn. You do not control outcomes. You control exposure. And exposure determines everything. Your emotional state, your decision quality, your longevity in this game. Becoming dangerous with risk management means you stop asking how to win more. You start asking how to lose better. Losses are unavoidable. Damage is optional. A controlled loss reinforces discipline. An oversized loss creates trauma. Trauma creates hesitation. Hesitation destroys execution. And execution failure is how traders spiral. Risk management breaks that chain before it ever starts. The dangerous trader understands variance. They understand that even a perfect strategy can experience long losing streaks. They design their risk so those streaks feel boring, not devastating. This requires abandoning the fantasy of fast money. Most traders secretly want one trade to change everything. That desire poisons their risk decisions. They size up emotionally. They justify exposure intellectually. They ignore probabilities because they crave relief. Risk management forces patience. It denies instant gratification. And that is exactly why it works. When risk is correct, you stop trying to be right. You focus on being consistent. You stop watching every candle like it holds your future. You let trades work. You allow setups to fail without emotional collapse. This is when trading becomes what it is supposed to be, a process, not a performance, not a test. Just execution of a plan you already decided was worth following. There is a moment in every trader's journey where risk management stops being something you talk about and starts becoming something you live by. It is quiet. There is no celebration, no breakthrough candle, just a subtle internal shift where you realize something important has changed. You no longer feel rushed. You no longer feel the urge to recover losses quickly. You no longer feel the need to prove anything to the market. That is the moment you become dangerous. Most traders think danger comes from aggression, from big size, from confidence, from bold entries and fast execution. But real danger comes from restraint, from precision, from the ability to walk away unchanged regardless of what the market just did. The trader who can lose and remain mentally intact is far more powerful than the trader who wins and becomes emotional. This is where risk management reveals its true purpose. It was never designed to protect your money first. It was designed to protect your decision-making. Money can always be made again. A damaged mindset takes years to repair. Every blown account is the result of broken risk boundaries. Somewhere along the way, rules were bent. Size was increased emotionally. Losses were treated as personal attacks, and discipline slowly collapsed under pressure. Dangerous traders understand that pressure never disappears. It only changes form. Early on, pressure comes from wanting to make money. Later, pressure comes from wanting to keep it. Both can destroy you if risk is not structured properly. This is why true professionals do not measure success by profit alone. They measure it by how consistently they respect their risk model. A winning month achieved by breaking rules is a failure. A losing month executed perfectly is progress. That mindset alone separates those who survive long enough to scale from those who keep restarting. At this stage, risk management becomes identity. You no longer ask yourself how much you can make on a trade. You ask how little you are willing to lose. You no longer fantasize about best-case scenarios. You focus on worst-case acceptance. This is not pessimism. This is clarity. When worst-case outcomes are accepted in advance, fear loses its power. You are no longer negotiating with price. You are simply executing a plan you already made peace with. That peace is rare. That peace is dangerous. Another shift happens here that most traders never experience. You stop needing action to feel productive. Sitting on your hands feels just as valuable as placing a trade. Waiting becomes active, not passive. This patience is not forced. It is enabled by correct risk. When your size is appropriate and your drawdown limits are respected, you no longer feel like every trade must count. You stop compressing your expectations into single moments. You allow time to do its work. Time is the real edge in trading. Most traders do not fail because they are wrong. They fail because they run out of emotional capital before their edge plays out. Risk management extends your emotional capital. It gives you space to be human without being reckless. It gives you permission to be wrong without being damaged. It allows you to think in sequences instead of moments. This is where compounding truly begins. Not compounding money, compounding behavior. Each disciplined trade reinforces trust. Each respected stop builds confidence. Each avoided impulse strengthens control. Over time, these small psychological wins accumulate into something unshakable. This is what people mean when they say a trader has presence. It is not arrogance. It is not certainty. It is calm authority. Markets sense desperation. They punish urgency. They expose emotional imbalance. But they reward consistency in ways that feel almost unfair. When you stop trying to extract money from the market and instead focus on managing yourself, the market becomes easier to navigate. You see clearer. You act cleaner. You recover faster. Losses no longer spiral into revenge. Wins no longer inflate your ego. Everything flattens into process. This flat emotional curve is not boredom. It is mastery. From here, scaling becomes logical instead of tempting. You do not increase size because you feel good. You increase size because your data proves you can handle it. You reduce size when discipline slips. No shame, no frustration. Risk becomes adjustable, not emotional. That flexibility is power. Many traders wait for confidence before they respect risk. Dangerous traders respect risk until confidence becomes unnecessary. This is why they survive volatility. This is why they thrive during uncertainty. This is why they do not collapse during drawdowns. They have already accepted loss before it arrives. Acceptance is the highest form of control. By now you should understand that becoming dangerous with risk management has nothing to do with complexity. It is not about advanced formulas or hidden techniques. It is about radical honesty with yourself. How much can you truly lose without changing behavior? How many losses can you take before discipline slips? How long can you wait without forcing action? Your answers define your current level, and the goal is not to judge those answers. The goal is to design your risk around them. When risk fits the trader, growth is inevitable. When risk fights the trader, collapse is guaranteed. This is the final truth most traders never learn. The market does not defeat you. You defeat yourself by ignoring your limits. The moment you stop doing that, everything changes. Trading becomes quieter, decisions become simpler. Results become steadier. And one day, without realizing when it happened, you cross a line. You are no longer hoping to survive. You are no longer chasing consistency. You are simply executing who you have become. That is what it means to be dangerous with risk management, not reckless. Not fearless, but controlled, grounded, and unbreakable.